Good evening, ladies, gentlemen. My name's Paul Merrick. I am standing in for Sunil this evening because Sunil's at a very important planning meeting tonight where he's trying to get planning through for 20 houses. So it was quite important that he was there. He did at the last minute ask me if I would stand in, and I'm going to kind of be co-hosting tonight with a couple of other people, one of them being Brian and the other one being Wayne, and taking care of the technology, because I certainly can't, is Dan. So I will introduce myself. I think some people may recognise me, some people may not. So my name is Paul Merrick. I've been a property developer and a landlord for 3 decades now of both commercial and residential property. I've also been a developer of commercial property and residential property. I'm a professional speaker. I'm a business consultant, and I'm also the co-author of a book called Unpacking Your Property Business Plan, which you can find on Amazon if you're so minded. I think the reason that Sunil asked me to come along tonight and take over this is because I am Sunil's business consultant and have been for some time now, and helping him kind of navigate his way through this whole new field that he joined a couple of years ago called development, although he's been in the property industry for 3 decades. Then it's unusual or new to him to be in this field called development. I always define the difference between development and buy-to-let as in buy-to-let you swim with dolphins, and in development you swim with sharks. It's a very different business. So what I'm going to do now is I am going to hand over to the 2 co-hosts. There will be about kind of 5 to 10 minutes kind of speaking about their particular topic, and then we'll come back to me. So I'm going to kick off tonight with Brian. If you want to introduce yourself, Brian, and then we'll go to Wayne.
Thanks, Paul. Yeah, I'm Brian Carey. I'm a tax partner at UHY Hacker Young in Sittingbourne in Kent. Like Paul, I've known Sunil. I've been involved with Sunil for a good number of years in dealing in property accounts, property tax, and the like. And tonight, I thought I'd do a brief. As I kept writing the slides, it got longer and longer and longer and longer. A brief update on something that will affect, I think, some people on this webinar tonight. MTD, making tax digital. Dan, have I got your screen?
Yeah.
Thank you. There we go. Making tax digital. It's you guys may have come across this. You may know a bit about it. You may know bits, you may know lots. It's one of those that just trying to get the arrows. There we go. MTD is something that is being brought in by the government. What is it? It is called, as I may have said earlier, it's making tax digital. What the government are trying to do is they are trying to basically cover the tax gap, or the perceived tax gap that they think they have. I can't get the slides to go forward. Come on, go forward. I think you're going to have to take over the slides, Dan, because I can't get them to move forward.
Yeah, no problems.
Thank you. Yeah, so what it's designed to do, as I say, this is government speak. This is not my speak. So it is aimed to promote, as I say, better and more timely record keeping. Why am I spouting on about this to you guys? It's going to affect sole traders and landlords with effect from 6th of April 2026. We have a year. As I say, it's designed to reduce errors and mistakes. It's the perceived tax gap that the government has. The basic aim is that it's asking landlords in this scenario to post their income and their expenses once, and once only, onto an electronic platform, digital service, such that it goes to the revenue via digital records, via quarterly updates, and ultimately a year-end declaration. One of the things that the revenue perceive is that the more times that an individual undertakes a manual transaction or a manual input into a transaction, the more risk there is of error. Hence, they're asking that you basically put in an invoice, a receipt once and once only. As I said there, what's involved is, as I say, MTD has three components. It requires digital records, quarterly updates, and a year-end declaration. And all transfers of data under this are designed to meet these requirements via these digital links. Okay. As I said earlier, who does it apply to? It actually applies, as I say, it applies to self-employed individuals and landlords, and it's based on a term called gross income, gross qualifying income, should I say. Now, broadly speaking, from 6th April 26, if you have gross qualifying income of more than £50,000, you are into MTD from 5th April 26. Okay. The threshold is being reduced to £30,000 from April 27, and somewhere in this parliament, it will ultimately come down to £20,000. Now, if you breach the £50,000 limit, you are mandated to be within MTD. How it works it out is it will look at your next tax return that you produce or your advisor produces. So it will look at the 24-25 tax return, so the year to 5th April 25. And if you have gross rental income plus gross self-employed trading income that exceeds £50,000, you're in. Okay. If you're below 50,000, you're not in this year. If you're above 30,000 next year, you're in 27. Okay. So I think as we're talking, and what we're talking about here is income. We're not talking about profit. We are talking about your rental income. As I said earlier, it applies to sole traders and it applies to landlords. Who it doesn't apply to, if you know, next slide, please, yeah, Dan. It doesn't apply to limited companies. So if your property is owned in a limited company or you're a director, this doesn't apply to you yet. Doesn't apply to partnerships and LLP. So if you're in a properly formed partnership or a properly formed LLP, again, doesn't impact you. It doesn't impact individual partners, members of LLPs either. There are some automatic exemptions. This is a strange one. If you don't have a national insurance number on 31st January, you'll be exempt from MTD. This really applies from overseas individuals who may not have a national insurance number. Trustees and personal representatives aren't included. Foster carers on their foster carer income only are not included. So if you're a landlord and also a foster carer, if your landlord income takes you over, or if your landlord income takes you over, you would be in, even though you just ignore your foster care income. And the other thing is non-resident companies aren't in there. Non-resident companies, they will all be automatically applied. You don't have to claim those exemptions. There are some other exemptions to be included in MTD that you do have to claim. The first one is it's generally aimed. This one is generally aimed at what used to be called the Plymouth Brethren. It's a religious sect, if you like, who did not partake in anything remotely that had anything to do with computers, electronics, anything like that. So if you're part of the Plymouth Brethren, you could say that and you'd be exempted. But you also, if you can't, I've done it the wrong way around actually. if you can claim to the revenue due to your age, your disability, or your remoteness of location, Paul being a good example, he's in the middle of Scotland, sometimes his IT doesn't work. If you can prove to HMRC that your IT doesn't work, you're of an age, or you have a disability that you are unable to undertake this through some sort of digital tool, you don't have an iPhone or whatever, they may grant an exemption, but you've got to apply for it. If you're subject to our insolvency procedure, or as I said there, if you're business run entirely by practicing members of a religious society, HMRC will grant you that exemption if you meet any of those conditions. But they have 28 days to either grant it or deny it. But they haven't at the moment confirmed how you claim that exemption. These exemptions, they're very similar to MTD for VAT, but if you've got an exemption for MTD for VAT, you have to make the claim for the MTD for income tax as a separate claim as well. It's not an automatic switchover. So on the basis you are in MTD, what do you need to do? As I say, digital records. Effectively, you have to have some sort of mechanism whereby you record your income and your expenditure in a digital form. Now, this can be on a spreadsheet, Excel spreadsheet. You will then need some sort of bridging software to actually file that over to HMRC at some point. Or it can be done on some sort of inbuilt, purpose-built software, some sort of accounting system. Your Xero, your QuickBooks, Sage, and there'll be many others. I think Hamaker, another one, especially for landlords, Hamaker, I think, available to do that. Once you've got your records in a digital format, you are obliged to make quarterly updates, which is basically you will be submitting to HMRC on a quarterly basis a summary of your business income and expenses every quarter. The quarters are fixed, so they will run from the 6th of April 26 to the April, May, June to the 5th of July. 5th of June, sorry, filed by the 7th of August. It is, those will be fixed. They will be quarterly requirements. The second quarter will include 6 months worth of income and expenses. The third quarter will include 9 months worth of income and expenses. Once you've got all 4 declarations together, you will make the fourth submission will allow, once that's gone in, you will then be allowed to file an annual digital return, which allows you to make adjustments for tax purposes and any other adjustments that you might consider needs to be made before it is submitted as it pre-populates, if you like, your tax return, before you put in your other sources of income like your dividends, your interest, and anything else. I did see a comment on there earlier that basically said it's a bit like Big Brother. Yes, it is. It's going to be interesting to see how the revenue handle this, because from my perspective, I can see that, I know how the process works in terms of a sole trader or a landlord. You will look at their accounts. You may not have included all expenses that you might generally be able to claim. We may make an adjustment at the end of the year. If we're not, if you, the landlord, are not doing this on a quarterly by quarterly basis, I do wonder whether a large adjustment in between quarter 4 and the digital tax return may, I don't know, generate an inquiry. I don't know. That's just my thoughts. At the moment, this does not change the tax filing dates. You still have to file your self-assessment deadline by the 31st of January following the year, and it does not affect the tax payment dates. So despite you filing your 4th quarter to 31st of March or the 5th of April 27 by the 7th of May 27, you will still have until the 31st of January 28, I've got my years right, to file your tax return. the fly in the ointment, if you like, you are doing this as individuals. So if you have a joint property, so if husband and wife own a property jointly, it is not an official partnership, so it's not out of MTD. They have to report this quarterly individually on their own share of that income. So you might have to have 2 sets of records, you might have to have 2 spreadsheets, 2 zeros, 2 sages, 2 whatever. It is a case of a husband will have to file his return based on his half share and the wife her half share. Now, under joint property owners, there are certain other limited exemptions whereby, for example, you can choose as individuals to file your income quarterly, and that's it, and file your expenses on a yearly basis on the 4th quarter. Or you can make a filing. It's something in our industry, there's something called 3-line accounts, which is basically on a self-assessment return. It's total income, total expense, total profit. You could file on that basis, just say total income, total expenses, total profit, and not make any breakdowns. But again, it's only on your share of the rental income in this particular case. As you would expect with anything like this, there are penalties. So if you make a late submission, then you will come across a penalty system whereby you are given penalty points. So if in your 1st quarter, for example, you have a return to file, you don't file it on time, you will receive a penalty point. If you, over the course of a year, accumulate enough penalty points that breach the threshold, and I believe the threshold is 4 penalty points, then you are subject to a £200 penalty. And then any subsequent late submissions will result in an immediate £200 penalty. The only way to reset that is to get everything on time for 4 quarterly updates, 2 years worth of filings, which shouldn't be a problem, but it can become onerous. It's all designed to keep your records up to date. There's no that the revenue are trying to get away from the sole traders and the landlords who turn up with a plastic bag of receipts at the last minute and expect everything to be done. They want it as they go. The one thing I didn't mention there with regard to the penalties is once you're into MTD, if you fall below the threshold, so if in 24-25 you have £50,000 of gross income, if in 25-26 that goes down to £30,000, you're below the threshold, you've got to be outside the threshold for 3 consecutive tax years. So in the scenario that the revenue have posted, they've said that if somebody has breached £50,000 in 24-25, but then has income of 30,000, 20,000, 10,000, 3,000, they will be obliged to be within MTD for all of those years, filing returns quarterly, all the way down. And they won't come out of MTD till 28-29, I think was the year they quoted. So it's once you're in. And it can become onerous. We are starting to talk to our clients now who we think are going to be in it, because the revenue will be writing to those taxpayers who they believe are going to be in it, because it's just about a different sort of mindset about how they report, how they record, and effectively how they sort of report that to the revenue. That really wasn't a scare tactic. It's more an awareness. It's coming. It has been kicked into the long grass a few times, but now we believe the revenue are up and ready and ready to go for it. So if anybody has any queries on it, my contact details are on the last page there on the screen. The presentation can be emailed out after this event. So if anybody's got any queries after that, I'm happy to take calls, emails, questions, whatever. That's me.
Fantastic. Not to say that tax dry, but everybody that's still awake, welcome back to the meeting.
Yeah.
It's always one of those things that you kind of have to deal with. And the topic tonight is going to be around about that as well, a kind of like, understanding tax and understanding accounts and how dry the subject is, but how important it is to talk about it. So thank you, Brian, for for introducing many people to that.
No worries.
And we'll try and talk about tax in a different way a bit later on and be a lot more interactive, I think. I'm going to now hand over to Wayne, who's going to kind of discuss finance.
Fabulous. Thank you very much. Let's grab my screen up. I hope you can see that, guys. Yep. Good. Perfect. Guys, good to see everyone. For those of you that don't know who I am, my name's Wayne. I'm the owner of DMI Finance. I've been arranging finance for investors personally for the last almost 19 years, and we as a company have been going for 23 years. Guys, we cover everything from buy-to-lets to bridging finance to ground up to developments to trading businesses to commercial investment properties. It doesn't really matter what you're looking to do. We'll have specific expertise in it. We're a commercial finance broker and we specialize in assisting investors. We've known Sunil from I guess more than a decade, maybe 15 years. We advertised alongside Sunil at the Clive auction for many years until it went online. And we've worked for Sunil as his mortgage broker for probably the last 6 or 7 years, something like that. So, that's how we've been invited to talk to you today. Guys, normally I come on, I provide a bit of a market update and then kind of focus on the headline rates. And if we do have any time, then I'll open up to some questions, but at least it'll provide my contact details if anybody has any questions. What to say, guys? Well, tomorrow we've got the Bank of England MPC meeting. It's widely expected that they will keep the Bank of England base rate where it is at. It did reduce at the beginning of last month, as you guys will be aware. Why? Well, we've got some stubborn inflation. Inflation for the 12 months till January came in at 3%, up from 2.6, I think it was, for the 12 months to December. So, it's widely expected that base rate will stay firm tomorrow. It's widely expected that it will stay firm for longer and have fewer reductions. Perhaps we'll see a couple of reductions this year, but that's, I guess a watch and see type point. That said, guys, swap rates, the underlying rates at which banks swap variable rates for fixed rates, have sat very static. You can see where they were on the 3rd of Feb, and you can see where they are here on the 17th of March. Now, I guess as a consequence of that, and equally as a consequence of so many fixed rate mortgage terms ending this year, we are still seeing some significant competition in the lending market. This year, we're expecting 1.8 million mortgages, fixed term mortgages, to end. So lenders all want a significant slice of that pie. Now, what we have seen, and I've mentioned it on previous presentations to you guys, is that we've seen lots of the challenger lenders come out and bring in product switch options. So that's where a lender wasn't offering you the ability to retain the mortgage with them after the end of your 2 or 5 year fixed. It was thanks very much, goodbye now. Lots of those lenders that did have that stance have now brought out a product switch proposition. Ultimately, guys, it's far easier for them to keep that business and offer you attractive rates rather than generate new business. In terms of headline rates, in terms of rate movements that we've seen more recently, tomorrow we're seeing, I guess, a couple of the big six. We're seeing NatWest, Halifax, Virgin Money reducing their residential rates tomorrow between 0.15 and 0.35, some pretty serious reductions there at the steeper end. Accord Mortgages reduced their rates today by up to 0.15%. The Mortgage Works reduced their rates last Saturday by 0.3% or up to 0.3%. We've seen Keystone reduce their rates. This is just a selection, guys, of the kind of headline reductions, but there are some pretty reasonable reductions taking place. In terms of criteria movement, there hasn't been a tremendous amount of criteria movement. You know, lenders, if they want the business, they'll try and justify bringing in the business via rate rather than criteria movement. Rate's something that they can very quickly change to kind of put the brakes on. Criteria movements, it's a little less subtle. What we have seen is Alaka Bank. I mentioned last month about Alaka Bank coming into the bridging space and coming in with, in a pretty deep way, offering 85% residential bridging, 80% commercial bridging. They've now, last week, the week before, entered the buy-to-let market. Now, I wouldn't say they've entered it particularly full on. I think their expectation is to lend £100 million by the end of the year. Now, put that up against, a traditional buy-to-let lender, and they're lending 300-400 million a month or something. So, it pales into insignificance, but, it's good to see another lender enter the space. We've seen fleet mortgages have enhanced their criteria. Guys, if you've used fleet mortgages, specifically when you're refinancing a property within the first 6 months, fleet were a little bit backward, and they want you to be registered as a legal owner pre-offer. Now, land registry can take a long time, and often the solicitor needs the mortgage offer to expedite that land registry process. So it's a little bit kind of it cart before the horse with fleet on their criteria. They've now said that actually upon receipt of a signed TR1 from the solicitor, they're in a position to release the offer, allowing you to expedite the land registry and allowing them to move forward with, like the majority of other lenders in that space, refinancing within the first 6 months. They've also opened up their criteria with CCJs. It's significant to them, but not significant in the wider pool of lenders, guys. Most lenders will happily accept kind of moderately low value CCJs, whether satisfied or unsatisfied. I think Fleet are now saying unsatisfied within the last 3 years, £250, satisfied up to £500. So not too significant. In terms of the number of buy-to-let deals, guys, it was announced earlier in the month that there are the most buy-to-let products on the market now than there has been since 2011. There are now, I did write it down, 3,560, I think it was, products on the market. So, a sheer number of products, guys. In terms of key dates for your diary, we've got the spring statement next week. We've, of course, got the Bank of England Base Rate Committee meeting tomorrow. So that will be announced at midday tomorrow. And then we've got the next ONS inflation data on the 26th of March. And then the next MPC meeting after tomorrow being the 8th of May. Guys, in terms of headline rates, and this is, I always mention it, this is the headline rates. It's not necessarily a true reflection of the rate that you'll get, because frankly, it's a smoke and mirrors game with lenders. They'll give to you on one hand and they're taking away in another. What a broker will be looking at is making sure that those rates align in terms of both the arrangement fees and the costs associated with it. Red indicates that the headline rate has increased. The kind of blue color indicates that it's gone down, and black indicates that it's the same as when we met last month. So, it's a variable position there, guys. 5-year borrowing has gone up slightly in terms of headline rate. Across the board, it's probably not, in truth. 2-year borrowing has gone down. One thing I would say, there are a couple of even more hypothetically attractive headline rates than those 2-year rates there. I think West One are offering a crazy low interest rate of, I think it might be 2.32 for limited companies, HMOs and multi-unit freehold blocks. I've left it off because the arrangement fee is 10%. Now it's, it just kind of highlights that smoke and mirrors scenario, guys. So I've left that off because it's not representative of the wider market. That's it from me, guys. Relatively short and sweet. There are my contact details. I will add, though, that we have a newsletter that we put out about any criteria changes, any product changes, the economy, property auctions, commercial auctions, whatever it might well be, every Tuesday. If anyone wants to register for it, then by all means follow the QR code there, or ping me an email, and I'll make sure you're registered, guys. That's it from me. Thank you very much.
Thank you very much, Wayne. So we spoke at you for 35 minutes, and now we want to speak with you. We're on a forum where you have a little microphone in front of you, and you can press that microphone and speak back to us. I'd prefer if you didn't use the chat. I would prefer if you actually kind of spoke to us. And the topic for tonight is something I was discussing with Sunil earlier in the week. I found myself on Facebook, and there was a question on Facebook about, do people understand their P&L? Right, and little did I know, because I'm somewhat naive to social media. You won't find me on many social medias, but it was actually a lead generator. Basically, it was somebody selling, surprisingly enough, a course. I still find myself after all these years shocked at that Facebook questions and Facebook posts aren't just genuine. They're lead generators. Anyway, and I answered it. And it didn't go very well down with the lead generator, because I said, anybody that already has a buy-to-let property, if they don't understand their P&L, then they probably shouldn't be in the business. Because at the end of the day, that to me is like going out on the road tomorrow and finding a driver with no license. One of the basic things in any business you should understand is your P&L. And I think there's two reasons why there was quite a lot of people who were interested in this course learning about their P&L who happened to be in the buy-to-let sector. I think one reason is because people don't learn about business and get into it. They get into business and then learn about it. And secondly, a lot of people in the buy-to-let sector don't really see themselves in business when they're entering the buy-to-let sector. They see themselves as investors. And then suddenly they find they've got all of these tax issues to deal with that Brian was touching on earlier on, just some of, and they've got all of the issues of running a day-to-day business. And I'm going to give you a definition that you might or might not agree with, and feel free to voice either way. I've had people disagree with me many times in life. It bothers me little. Right? In fact, it's called a debate, and I quite like them. I think if you rent property or you sell property, you have a customer. And if you have a customer, you have a business. If you rent property or you sell property, you have a customer. You might call him a tenant, but he's a customer. He might be managed or she might be managed by somebody else, but he's still ultimately, or she's still ultimately your customer. And if you have a customer, you have a business. You don't have an investment. I invest in classic cars, prestige watches, art. There's no customer. Shares, no customer. But property, if you're a property owner and not investing in a REIT, you have a customer. And it's your duty as a business owner to understand business, and part of understanding business is understanding tax. So what I want to talk about tonight, and I'd like people to be frank and honest, is how well you understand your P&L. Can you pick up a P&L that Brian's prepared and instantly understand it? More importantly, could you prepare a P&L without Brian or somebody like Brian? Because if you're running a business and you're taking care of people's homes, then it's important that that business succeeds and doesn't fail. It's important that at any point in time you understand whether you're in the black or whether you're in the red. Because if I'm a window cleaner and running a business as a window cleaner and I go into the red, you don't get your windows cleaned this month. That's terrible, isn't it? You won't be able to see the rain. But if I run a property business and I go into the red this month, somebody loses their home. So do you understand your P&L? That's the question. We've got about kind of 40 minutes to discuss this. About 7:30, Dan, yeah, we usually wrap up. So I've got about 40 minutes to discuss this. So obviously the first person I'm going to go to, I'm going to volunteer is going to be Brian, right? Because I hope that Brian understands a P&L. I'm working on the principle he might, right? I'm going to ask them a question. I'd like you to be very frank about this, right? If you went to your whatever it is, say you've got 200 customers, 300 customers, whatever you have as an accountant,
Yep.
How many do you think could write their own P&L?
Most. Before I answer that, I have dealt with a number of clients whom I have acted for numerous years, and part of our service, if you like, is we will prepare a set of accounts, and included in the cost is a meeting, a client meeting, maybe face to face, maybe a Zoom, maybe Teams, maybe whatever. And the number of clients whom I have had feedback from where they've either commented, oh, this is the first time my previous account didn't do this for me, didn't go through the accounts with me, didn't say that. Has been, well, I too numerous to mention, frankly. One, I actually saw a client on Monday, not in the property game. Basically, he has a very good October because he sells pumpkins. Buys pumpkins, sells pumpkins. And he came in and he said, no, it's good to come in, Brian, because I actually learn about my business. You actually go through it, you learn about my business. So you can take people through their P&L, take people through their balance sheet. They will then, I almost want to say, not the penny drops, but it's, okay, yeah, that's how it fits in. There are still things that people don't understand, mortgages being the biggest one, where they'll say, I pay £2,000 a month on my mortgage. Yeah, but how much of that is interest? How much of that is capital? And what do you mean? What's the difference? Why? What's the difference? And there is in accounting terms, there is a difference between the two. So it is. I think going back to your question, Paul, I think a lot of my clients could try, and I think a lot of people on this call could try and do a P&L. Whether they would get everything correct in terms of claiming everything they're entitled to claim is another issue.
Sorry, I'll press my microphone. My mouth and the words work at the same time. It's a wonderful thing, this technology. By the time I'm 103, I'll get used to it, It's only gives me another 5 years, but never mind. I think there's a lot of people in businesses generally, but I think particularly in the buy-to-let sector, because people don't go into if someone goes into my window cleaning analogy, they know they're going into a business, right?
Yeah.
And they understand that. I think there's a heck of a lot of people get into buy-to-let and they don't really understand that they're in a business. And that they need to understand the nuts and bolts of a business. I remember chatting many years ago, Brian, you might get a giggle out of this, to a chap who made more money than me, right? And he said, Paul, I make more money than you. And I said, yep, you do. You do that all the time, Mick. And he said, but you've always got more money than me. And I said, yes, I'm just better at keeping it.
Yeah, that's it.
And what I meant by that was not saving it, but not giving it to the tax man.
Yeah.
And Mick was very good at making money, and he was terrible at understanding his tax situation. And he probably had an accountant, no disrespect intended to accountants, Brian, but he probably had an accountant that was about as good as him.
Precisely. I mean, I think in that scenario, you need to be speaking to your accountant. The amount of clients who will, I said in my presentation, the revenue trying to stop people with their plastic bags of receipts turning up at the accountant's doors, going, "Oh, here's my receipts. Can you do my accounts?" That's all well and good. That could be dealt with, but there is no opportunity there for planning. That is all last minute. No idea what's going on, and that they will be running their business from their bank account. Have I got enough cash in my bank to live, to do whatever? And what you're describing, Paul, is a proactive person who is speaking to his accountant and planning.
Yes. because it's the difference. It's the major difference, right? I've come across two types of accountants. I hope Brian fits into one category and not the other. There is bean counters.
Yep.
A bean counter, you go to that accountant, at the end of the year, he tells you how many beans you've had in, how many beans you've got out, and how many beans you've got to pay to the taxman. And there's no sense of planning those beans in any way, shape, or form. It just counts the
No.
beans in, counts the beans out, and tells you how many you pay to the taxman. And then there's an accountant, and more importantly, a business owner, because one without the other is a waste of time. You can have a really good accountant, but if you're not willing to learn and you're not willing to take on board what your P&L means, then you can have the best accountant in the world, and all he can ever do is tell you how many beans have been in, how many beans have been out, and how many beans you pay to the taxman. You need to be involved in this. You really need to be involved in this, right?
Yeah.
It's your business. It's not your accountant's business. It's not the Inland Revenue's business. It's not your customer's business. It's your business. So understanding P&L, I was astonished, right? Having been in business for 45 years, been a business consultant for 20 years, I was astonished how many people answered this lead generator saying, I'd like to learn about my P&L. When's the course? And these people already proactively had buy-to-let businesses.
Yeah.
So, as I say, I'm talking at you again, so talk back to me, right? And you don't have to be nice. No matter how hard you swear at me, my dad swore at me better, so you can say what you like, right? But come back to me and say to me, Paul, I don't understand the P&L, or listen, I completely understand the P&L, or there was a time I didn't. Just be honest, because these sessions, right, shouldn't be talking at you sessions with loads of information that you kind of remember 10% of when you leave. Anybody do that? They listen to these things and go away with about 10%. Yeah, is that just me?
Yeah.
Right.
No.
Everybody else goes away with 100%. I'm just a bit thick, Brian, apparently.
I don't believe it.
Yeah. I've done okay for a thick guy. I'm going to be clever one day and make a proper living, right?
Indeed.
So talk to me. Tell me about your P&L. Tell me about understanding a P&L. Tell me how relevant you think your P&L is, because I think it's probably one of the most important things you can understand in a business. Not all at once, one at a time.
I was going to say, I'll go first. My name's Summit. Good evening, everyone. I'm based in the Midlands, Birmingham, and I'm glad you're talking about this, because this is something I've started to look into recently. I'm one of them accidental landlords where when I was younger, my dad got me into property and I just let it sit in the background. And now I've started to take it more seriously and started to look at profit and loss and speaking to my accountant. And one of the things I've picked up on is how much I've missed out on actually organizing myself and getting myself ready and doing it properly, as they say. And at the moment, I'm creating spreadsheets myself and trying to track my monthly income and expenditure and on a more, and I've backdated myself a few years to try and analyze what I've done up until now. And it's just a bit of a shock at how much I could have saved and how much I could have actually organized myself better. And if I did it properly, what I would have done different. Going forward, because I can't be looking backwards anymore, got to look forward. Getting settled correctly is the best way, and making sure that you do your calculations and get your whatever tool you're going to use. I'm good with computers, so I'm good with Excel documents. It's a bit manual, but it keeps me, for me personally, if it's a bit more manual, I'll sit there typing numbers in. It shows me what I'm doing. Whereas if I put it on a little app, it's kind of like in the background, it's just done, go away, I won't look at it again. Whereas if I'm physically looking at something, I personally find it better for me. Don't know how other people feel. The one thing I wanted to ask was, what tools do you, Brian, what tools do you use or do you share with your clients to help them?
Depends what they want, to be perfectly honest, and where they are. I mean, you're right. It's whatever works with the client in terms of software. If you're a spreadsheet guy, fine, do a spreadsheet. Not gonna sort of try and teach you astrophysics if you can't. Not wire a plug. I can't even do that. You know what I mean. I'm not going to teach you something that you're not going to be uncomfortable with. From a software perspective, we're we like Zero software. It links in with most good things, and as I say to most of my clients, be them buy-to-let landlords, be them trading companies, whatever, you can't break Zero. Whatever you do on Zero, be it right, be it wrong, I can correct it very easily. Some of the Sage and QuickBooks, you have to go through a little sort of paraphernalia, if you like, to correct times. But Zero you can do. But I'd never sort of, force somebody down a road if they're not comfortable with it.
Can I just say that the best tool you can have for a P&L is your brain?
Yeah.
That's the best tool. It's not about buying a bit of software that's going to do it for you. It's about you understanding it. That's the most important tool.
It's still
I want to pick up. I want to pick up on a couple of points that were made there. Right. Accidental landlord. I love this phrase, accidental landlord. How did you become an accidental landlord? Well, I had a flat and then I bought a house. So I kept the flat and I rented it out. Right. Have you ever bought a car and still had a car that you had to sell? Yes. Why didn't you rent the car out? Why didn't you become an accidental car rental company? I don't understand the accidental landlord. Yeah. I've never accidentally got into a business in my life before. There was a great professional speaker and motivational speaker called Zig Ziglar. And he used to say, I don't understand fat people. How did you accidentally eat a hamburger? It's a bit like that for me in accidental landlords. You can't accidentally do something. And as a business consultant, there's 3 times that I'm invited into a business. There's the really good time, there's the okay time, and there's the bad time. The really good time is at the start of the business. So you get everything right from day one. The okay time is fixing the mistakes that's been made over the last 1, 2, 3, 4 years. And the really bad time is when the business is so far down the tubes because there's been so many mistakes made, there's nothing anybody could do. And, the time to ask for help is the time that people want to ask for help least, whether it's from an accountant or whether it's from a consultant of any shape or kind. I remember when we first started our business, and we have a multi-million-pound debt-free portfolio now, which consists of both residential, commercial properties and development sites. And I started my business with £40,000, and one of the first things I did was take on a business consultant. And all of my friends, those people who give you great advice, they've never done anything with their life, but they give advice all the time. They're very good. They said, you can't afford a business consultant. And I said, I can't afford not to have one, right? Lots of people start small businesses and think they can't afford an accountant. What's your view on that, Brian?
I go back to you can't afford not to. I've been to very, I've had it. I've had every comment thrown at me for want of a better term as an accountant. Oh, what do you charge? Give them a ballpark, or too expensive. Okay. Half of me wants to say, well, come back when you're in a mess, and it'll be double sort of thing to get you out of that mess. But I won't say that. But that sometimes is what is how you feel. Sometimes you give them a you need. You'll agree with this, I'm sure, Paul. But property people, especially businessmen, you need to surround yourself with people who understand your business, understand what you are, what you're doing, and how they help people.
But the only thing I would put to that is, because I think there's a lot of people in the property sector who take that too literally, Brian, and they think, okay, I've got my accountant that looks after this, I've got my agent that looks after that, I've got my builder that looks after that, right? I remember speaking at an event before COVID, and I was about as popular as a fart in a lift, to be honest. Yeah. I was standing there and I was saying that most people kind of get into property and they say, right, okay, I'm going to find an agent who's going to find me the properties. I'm going to find a builder that's going to build the property. I'm going to find a broker that's going to find me the money. And I'm going to find a letting agent that's going to actually let it out for me. And the question I always have is, what do you do for a living then? This is a job. being in property, if you want to make a reasonable success of it, and I think I can speak of that, being here for 30 years and making a reasonable success of it, is a job. And when you start to treat it like a job in a business, boy, it changes the whole outlook. Trish, I think you had something you wanted to say.
Thanks, Paul. Yeah, you are aware of my recent software issues, I know. Zero, I had a meeting with my accountants yesterday, and it is not fit for the needs that I have for across my businesses. So we've got to look at something else. But also, I had a discussion with my accountants. I meet him twice a year, and I find it gets too complicated. I just want to know what the profit margin is. And the pages just go on and on and on. And by the time I've got through halfway through the first page, it's too much. I don't know if that's normal and I'm just a bit thick, but every time I meet him, I try and I ask questions and I try and grasp what's in it. And there is always still stuff that's, you might as well be speaking in French. So I don't know what to do about that.
Well, to a certain extent, they speak in tax, they don't speak in French. And tax is deliberately in this country meant to be complicated, right? We're not supposed to understand tax so that we spend more on it, essentially. I don't know whether you would agree with that cynical view, Brian, but that's my view of the inland revenue.
The whole, however many years it's been of the phrase making tax simple, or whatever the phrase is.
Yes.
It's rubbish. I could show you the tax legislation that's sitting on my shelf in a room next door. I haven't read it all. I'm not saying I'm the best at it, but I haven't read it. You're supposed to know this, guys.
Yeah.
You haven't even seen the books. You know, it's making tax simple doesn't work.
I'll tell you the answer, Trish. The answer is like eating an elephant. It's one bite at a time.
Yeah.
Right. So you don't try and understand the UK tax system. I've been working on that for 45 years and I'm relatively good at it. But like Brian, firstly, by the time I've learned something, they've kind of outmoded it or changed it or, implemented something different. Right. You're never going to understand the UK tax system. You may never understand your set of accounts. I feel I do. I've been in business for 45 years and I am a business consultant. Perhaps you might think I should. Right. I can break down a set of accounts, but your P&L is not that complicated. So the next time you sit down with your accountant, say, right, I don't want to know about all of that. I want you to go through a P&L with me, a profit and loss, right?
Yeah, I can go through that. That's fine. Got that. But then it just goes on to more complicated stuff that just goes over my head. I can't seem to retain it. I think I've got it. And then when I go back and look at it next time, I'm just like, I can't remember what it was on about.
Tell you what the difference is, Trish, right? The difference between understanding your P&L and understanding your tax return is you might accidentally pay a bit more tax if you don't get your tax return right. Your business will disappear if you don't get your P&L right. One's useful information, one's essential information. Useful, essential. That's how I kind of split my life up, right? People go about and learn a lot of useful information, or as I would call it, useless information. Right, it's useful, but you're probably never going to use it, right? But what they don't fill their head with is essential information. Yeah. Essential information. I think for any business person, no matter what business you're in, understanding your P&L is essential. That's why I was shocked by this, magnet that said, "Do you understand your P&L?" and the amount of people that came back and went, "They don't." Understanding your tax return. Brian's probably very good at what he does, right? I'm guessing he is because Sunil uses them, so I'm kind of guessing he is. Right? I'm only biased because Sunil uses me, so I think he picks good people, but I might be biased. Right? But he will sometimes. Sorry, let me finish.
I'm going to say, what is it you do other than property?
Other than property?
Well, you said I want to know what the return is on my business. I think that was the question you had of your accountant, which you didn't.
No, she said margin.
Margin. So what was the margin on your business? So
Yes.
what business is that you're talking about? Is that the rental business or is that another business?
We've got a rental business. We've got holiday lets and property management lettings
Right.
for other landlords as well. So each company that each business has its own company, and each
Yeah.
company has its own zero account
Okay.
to keep it clear and simple, because they obviously each one is a separate business.
Mm.
But the zero can't cope with the letting agency requirements. It's fine on a rental collection on the rental company. It's fine with the developments that we do. It's
Yeah.
fine with the holiday lets. It cannot cope with the rent collection side of things.
That's the client. I must pay the client account side.
Yeah, client account, agency account, business credit card. There's too much.
Yeah. Okay.
So the point I was going to make, Brian, is that even Brian, sometimes if you're putting in, 200 sets of accounts, there will be times that even as a great accountant, he will still miss. We could have saved £10 tax there or £200 tax there. He will miss it. It does happen, right? And that's okay. We can live with that as long as our business is making money. But it's damned annoying when you spot it later. Well, I find it damned annoying when I spot it later,
Indeed.
Brian. But
Indeed.
and I try and claim it in the following year if it's humanly possible. But
Absolutely.
I
You know
do,
the tricks.
I do hate it. Yes. Accrued costs is a wonderful thing, right?
Indeed.
But so you've got to speak tax, right? And that's what really understanding your P&L does. It helps you speak tax, right? So me and Brian could probably, I haven't been in business for 45 years, and Brian looks like he's been an accountant for more than a week. I'm reckoning we could speak a language here that's corporate tax language and lose a lot of people. I could talk about things like de minimis, right? And really lose the audience if I wanted, right? But that stuff doesn't really matter. It matters when you're making 100, 200, 300, 400 grand a year. But your P&L matters when you're making 10 grand a year. In fact, I would argue that your P&L matters more when you're making 10 grand a year than it does when you're making 300 grand a year. Because if you get it a little bit wrong at 300 grand, you might make 280 grand. If you get it a little bit wrong at 10 grand, you might lose 10 grand. So any other thoughts or questions or queries on this whole P&L?
Ben had his hand up.
Who did, sorry?
Ben.
Me.
Yeah, Ben.
Yeah, I've got to speak to my accountant in the next couple of weeks because I'm determined to try and understand depreciation of tangible assets.
Okay.
And I thought I understood it, but I didn't. So is there a difference between any vehicle depreciation or your plant and machinery depreciation? Is that what tangible assets are covering?
Yes, so tangible fixed assets are things. That's a tangible. A phone is a tangible fixed asset. A calculator, things. Motor cars, whatever. All depreciation is doing in my world. I have a professional body that says we have to measure the usefulness of those assets over their what is termed useful life. Okay. So taking the car as the example, if you buy a vehicle and you expect that vehicle to be useful, you're not going to sell the vehicle. You're not going to sell a machine. That's right. Start on that premise. You're not going to sell it. That car will be useful for 8 years. You would run it into the ground by then. Okay. So what depreciation is designed to do is it's designed to say, well, whatever that vehicle cost you, £40,000, we are going to write off over 8 years. So at year 8, that vehicle is worth nothing.
Okay.
And so there are various depreciation policies. You can have a straight line policy whereby you write the same amount off each year. You can get a little bit more complicated, and you could do something called the reducing balance concept, which basically means as the machine is newer, car is newer in the first year, you'll use it more, so you'll write more off of it. And it depreciates over a period of time. But ultimately, it's trying to put in the profit and loss account an adjustment for the assets that you've bought that have provided you with the ability to earn what you earn within your business, and it's given a charge against your profit in your profit loss against for those assets. That's all it is. It's an accounting concept. It's not a cash concept. It's an accounting concept.
So thank you for that. So if that's, say you buy a piece of machinery that's 10 grand,
yep,
and it's going to last for 5 years.
Yep.
So I presume that means if you did the straight line depreciation, that's going to be 2 grand a year. So
correct.
From what I would like to know, that there's the hole that I need filling, is what happens with that 2 grand figure. Does that mean that I'm not going to pay tax on that 2 grand, or doesn't it work like that?
Aha. No, this is an accounting concept. So from a tax perspective, whatever your profit is after that tax, I come along and say, sorry, Ben, I've got to add that 2 grand back. So you are taxed before depreciation. Okay. Having said that, if that acquisition is a qualifying asset for something called capital allowances, you will get capital allowances on that asset. Now, depending on what it is, capital allowances are allowable for tax, depreciation isn't. For want of a better term, for most people, they're the same thing. One just replaces the other. Okay, but there's different rules. So if you are I'm not going to use a property business. I'm going to, if you've got a trading business, you make machines or whatever, you have a machine that makes things. At the moment, if that machine costs you, as you say, £20,000, you would write that off over 5 years, £2,000 a year. For tax purposes, I'll come along and say, good news, Ben. I'm going to knock £10,000 off your profits this year for tax purposes, because you will get 100% capital allowances in year 1 on fixed assets. So your profit for tax purposes will go from whatever your profit is, I'll take off 10 grand, and you'll get tax relief there.
Hey, Brian.
So the capital allowances aren't directly linked to depreciation. It's just depreciation is an accounting term. Capital allowances is an allowance.
Capital allowances is a tax term and can be manipulated, if that's the right word, by the government as to what rate of relief they want to give you. So again, I look at my tax. There are most probably I don't know. There's most probably 5 or 6 rates of relief that capital allowances can be applied at. 100%,
Okay.
could be 100%, 18%, 8%. 25, there's 25, yeah, 25% might be in there somewhere.
There's 25, yeah.
There's a 25. I lose track of which year we're in and where. So
yeah,
depending on what your asset is and what it is and what rate is applicable to it, you could get 100% relief, 25% relief, 18% relief, 8% relief.
Okay.
4% relief is a building.
yeah.
But
Hey,
for
Brian,
depreciation, your accountant could turn and say, we're writing off over 8 years, straight line, 20%. There you go. There'll be a mismatch.
Okay.
Paul and Brian, it's Kundan here. I've been listening
Hello,
quite
Kundan.
intently. Hi guys. I've been listening quite intently, and everything that Paul has been saying. I mean, understanding of your P&L and your balance sheet is so much important. I mean, that's the crux of it. That's what I've learned in the last 2-3 years, focusing on your P&L and balance sheet. So just talking along those lines, one of the things we have started doing in our accounting practices is every year we mark to market our assets based on the house price index. So if, let's say, for argument's sake, I have £5 million on my assets, then I would mark to market by 10% if the HPI in January of that year is 10%. we would increase the asset value and basically place that as shareholder
Well, you broke up there.
on our books every year of depreciation on property. It doesn't make sense, except some plant and machinery being some laptops. So we've done away with the whole need for looking at depreciation if our main assets are property, you see, and they are generally going as per the house price index. Brian and Paul?
Again, I'll let Brian answer this. He is the professional, but I think we're talking about types of property. I think you're probably wholly or completely holding residential property. Would that
I
be
am
correct?
only talking resi. Yes. For argument's sake, so we've got separate companies for commercial properties. That is a completely different business. But we are only talking of resi, which I would imagine a lot of people on this on this podcast or discussion would generally interest themselves with resi properties.
Yeah. So as you say, again, residential property held as an investment, you can do what you're doing, Kundan. I.e., you can effectively value it each year and recognise that value within the accounts on an annual basis.
So what we have seen is, if I can just interrupt you one more time, because now we are sort of at a level where we are borrowing in tranches of upwards of 1, 2, 3 million with substantial assets to back our business. Now that we are in a established space, what most larger lenders want to now see is how much equity have you got in business, as opposed to the profit that the company is making. So our profit figures are generally, we will show a paltry sum of profit every year because we're reinvesting our profit into buying more assets and revaluing our assets every year and increasing the equity in the business. And so it works like a nice little cycle that the lenders also like, that every year on year, your balance sheet is showing, assets going up by 20-25% each year. You see where I'm coming from? Your debt also goes up, obviously, alongside the first charge debt will also go up. But looking at it from a professional sort of investor point of view, people who are operating at
We've lost you again.
Yeah.
I just want a side point.
Some of the lenders would want.
Sorry, you're going in and out. Either if you could find a better spot or kind of let some other people speak. I don't like this term. It's one of the things I found in the UK that I don't tend to find when I go to other places in the world.
Yes,
when
sorry,
you talk
go ahead.
about
Go ahead, Paul.
thank you very much. When you talk about property, I'll tell you a story. Many years ago, when I first got into property, I was wandering down a street in Glasgow called Maryhill Road, which is a really long road, right? And it's got shops on that, it's got housing on it, it's actually got farms on it. It's a really long road in Glasgow, and I was walking along it. And here's why I got into property. Here's what struck me. There was commercial property, there was residential property, there was industrial property, there was agricultural property, and somebody was making money out of all of those. And I figured, why shouldn't that be me? And if you look at our portfolio over the last 30 years, I mean, we're currently working on a battery energy storage facility. So we've done just about every type of property that you can name in terms of industrial, commercial, residential, and agricultural. Sheep have even paid me rent. I won't say how they paid, but that's another story. But we should stop looking at property as a 2-bedroom buy-to-let or a 4-bedroom house, because that's like going into a business that sells cars and saying, I'm only going to sell used cars. I'm only going to sell one model of used car. Why would you restrict your business? If you was going into the used car sales business tomorrow morning, why would you say, I'm only going to sell Fords and I'm only going to sell this particular model of a Ford? That would be such a limit to your business, wouldn't it?
Mm-hmm. Yep.
If we're in property, guys, we're in property. Shania, I know you've had your hand up for some time. Do you want to come in?
There were just a couple of things I wanted, just some comments really. Many maturer landlords who don't have incorporated portfolios find it very confusing, because obviously their P&L on their for their portfolio, you know, because of Section 24, they can't get their head around the fact that they've got a paper profit but a tax loss. And that's one thing that really is important for accountants to get across. And there's something else. Well, there's two things actually from the last speaker who was speaking. It's all very well doing this revaluation reserve, but you're telling the whole world what your assets are. And quite frankly, most smart accountants use 105 and then do a departure note to the banks and building societies as to how much the portfolio is worth on a RICS value, because we don't want to willy wave at company's house, because everybody knows it's like having a Range Rover on your drive. So you really don't want to do a 102 1A. The last comment is, and I've just wanted to share this, it's nothing to do with what we're talking about, but it's a nice thing to share. If anybody's got any unused NIC allowances, they need to claim, they need to top up their NIC, and then they can top up their pension. Paul, you probably know about this, but you need to go through any of your unpaid NIC for the years, and then you can buy each year for, I think it's about £900, but then that adds on thousands of pounds for when you claim your pension. So I just wanted to share that in case anybody can benefit from, because the window closes on the 5th of April and then you're stuffed. So just a couple of comments, and the NIC, that's my top tip for today.
So, anybody else got any thoughts on understanding or lack of understanding of a P&L? Because it's not, you know, it's not a sin in life if you don't understand your P&L. It's probably a sin in life if you don't kind of mention it, though, because this is a good opportunity to kind of talk about, right, okay, why don't we understand our P&L? What is our P&L, and why is it so bloody important? I think they're all relatively good questions. We seem to have a very educated crowd. I think we have, I can't remember, I think I've seen about 40 people in the room, 37 people in the room. We've lost 3 with their exciting talk. And it was time for dinner. So 37 people kind of clearly understand all of this.
Sorry, I was going to say, Brian, if you could just go through like a rough or a short breakdown of what a P&L is and how it's structured, and the most easiest way to create one or how to use one. Would somebody be able to share that?
Well, I think that depends if 37 people in the room already understand it or not, or if we've just got very shy people who
I think everyone's just shy.
who want to be more intelligent or more experienced or more capable than they actually are. You know, I've learned a lot about tax, and I've learned a lot about my accountant. Brian says that if I ever properly retire, I can get a job in his place, and my solicitor says that I can become a paralegal. Right. And do you know how I learned all of that stuff? I used to sit in front of them and go, right, I don't understand that. Talk to me like I'm 3.
Yeah.
Talk to me like I'm a child. Right. And here's one of the problems, I think. Right. I think a lot of people are frightened to go to their accountant, their solicitor, or in this room and go, I don't bloody understand that. I'd just like to point out I've been in business for 45 years and I've done relatively well in all of the businesses I've had. And there's still a lot of shit I don't understand. But what I'm very quick to do, particularly when new legislation comes in, is go to somebody like Brian or somebody like one of my solicitors and go, I don't understand this, Brian. Talk to me like I'm 3, right? And I think the less willing you are to do that in business, the less willing you are to be as stupid as I am sometimes, the less you will ever learn and the more trouble you'll probably find yourself in. Ashal.
Yes, I think it's following on from what Sumit was saying as well. What really like to hear is the sort of the main components of the profit and loss from yourself, Brian. And I think what I'd be keen to hear from you, Paul, is the insights from a business perspective. So I think that'd be I'd find it really useful if, I don't know if others feel, but I'd find that'd be really useful to get the insight of the technical and also from the business perspective and how that kind of ties in.
We just have to be careful, Brian. We don't bore the other 36 who know all of this
indeed.
backwards.
It'll be so in essence, your profit and loss account will record your income, and off against that will be set the expenses, revenue expenses that you have incurred to generate that income. That in a nutshell is what a profit and loss account is. So if you have just got, and I don't mean that in any bad way, if you've just got rental income, so right, I've got rental income, what costs have I incurred to generate that rental income? So off the top of my head, without really thinking about it, if I use a managing agent, I've got his commission. Clearly, if the property needs repairs, I need to insure the property, so I insure insurance. If I
mortgage
interest, if you borrowed the money to buy the property, the interest on the mortgage and other loans, so not just the mortgage, loans, family loans, whatever. If you are managing the property, travel costs of going to the property if you have to, telephone costs if you are managing that property, speaking to lenders, speaking to the tenant, whatever, about what rental arrears, legal costs in chasing rental arrears, throw some more at me. I mean, it's whatever you guys, advertising. If you've got a void period, if you're advertising, if it costs you 20 quid to put, I'm showing my age now, if it costs you 20 quid to put an ad in your local paper, it's whatever costs that you incur to generate that income.
Brian, you forgot
Now,
an important cost. Your costs.
Sorry, thank you, Imran. My costs. Yes. It's whatever. Now I will have conversations with clients, and just like Imran there, mate. So what we're saying with Summit and whatever earlier is they may come with Dan, may come across and say, what about this? What about my car? Yeah, okay, we need to think about the asset, another asset. That might be something totally different. We are just here talking about costs that you incur, period costs, if you like, not asset costs, period costs.
Okay, and I'll take it from a business point of view, and to pick up on Imran's point. I remember doing a business study course when I was 18. I did my first business study course when I was 18. I'm doing one at Harvard at the moment because you never stop learning. And disappointingly, I'm doing the Harvard one online as opposed to flying over there every week, but we'll get there. And I'd done a cash flow forecast, and I gave it to my tutor, and he said it's wrong. And I went back and I did it again. I started my first business when I was 15, so I was already running a business and making a living by this point in time. And I went back again with my cash flow forecast, and he went, it's wrong. And the third time I did this, because I'm a wee Glaswegian boy, and he said it was wrong, I swore at him. I said, what's wrong with it? And he said, where's your wages? And in my cash flow forecast, I forgot to put my wages. Right? That was a huge lesson. So let's talk about that P&L. We've only got a few minutes left, but let's talk about that P&L. See, one of the most important things about a P&L is everything that Ryan says is true, but he forgot one important thing, timing. Because what keeps a business afloat is called cash flow.
Yeah.
So if you are doing a year-end P&L, it's too late. because you might have found that there's costs that have come in that you don't have the money to pay out. So let's say that we're buying that proverbial 2-bedroom buy to let that I love so much, right? And you buy that 2-bedroom buy to let, and I go to Wayne and I say to Wayne, can you get me a mortgage? And he says, yes, here's my fee. When do I have to pay that fee? I have to pay that fee now. Well, I haven't got any income from my buy to let, have I? So on my P&L, I've got a big red line that says Wayne's fee, right? And then I've got to refurb my buy to let. And how many big red lines do I have then before I actually get to the point which has got the green lines on it? And what most people do is they don't understand that a P&L isn't for Christmas, it's for life, right? You need to be doing one, I would suggest, on a monthly basis. But depending on the cash flow in your business and depending on how short of money you are, right, I would say on a weekly basis. This P&L at the end of the year is fantastic. It's like that bean counter that tells you how many beans you've had in and how many beans you've had out and how many beans you own the revenue, how many beans you owe the revenue. But you can be bankrupt by the time your accountant gets around to telling you that. A P&L should be something that you do on a regular basis. And you should understand what's going out this week and what's coming in this week. And where does that put me this week? Because I don't know about you guys, right? But I have this phrase that I use a lot, and all of my clients will tell you this. I call it going to Tesco's money. I'm only interested in going to Tesco's money. I've never been interested in, I mean, the capital growth we've had in our properties are unbelievable, and I don't give an F about it because I can't spend it in Tesco's. The money I care about, the money that keeps my business going, the money that's built our business for 45 years is called cash flow. How much is going out this week and how much is coming in this week? And how did I do this week? And then this week becomes this month, and then this month becomes 2 months, and then this month becomes my VAT quarter. And at any given time, right, and, you know, I run 9 businesses. At any given time, Brian could ask me where we are on any one of my 9 businesses, at least on a monthly basis and probably on a weekly basis, Brian, and I could tell you, right?
Yeah.
And that's what a P&L is all about.
Yeah. There are, I will have clients, I don't know, there may be some in the room, there may not be. There are clients who run their business by what's in the bank. Have I got enough money in the bank to live for the next month? And that's how they would and as Paul is saying there, it's a little bit, there's a little bit sort of cash flow. You need that cash flow, and that will flow into, to a certain extent, what I do at the end of the year, the profit and loss account at the end of the year. This is what you've done. But it is important that you look at that on a more regular basis than once a year, twice a year with your accountant. It's knowing what goes in there. And as Paul says, the timing of it, that means that whether you can afford to do it or not.
I had a friend, I had a friend, Brian, we're not friends anymore because it got on my wick, to be honest with you, because people's livelihood were dependent on it, right? He panicked at every VAT quarter because he'd never put the VAT aside because he didn't do a P&L, right? So he presumed if there was 50 grand in the bank, he had 50 grand.
It was his.
Most of it actually belonged to the VAT man. Right? And he didn't have a tax. He always panicked at the end of the year when he had to pay his tax. Because he didn't have a P&L. And that's the point of a P&L, guys. If you understand how a P&L works, and I've wasted my time tonight, and all 35 people who didn't speak completely understand their P&Ls, and you know, you're all geniuses, then
Sarah's got her hand up, Paul. I think it's the last one.
Right. Where are we?
Sarah Lindo?
Okay, Sarah, on you go.
Good evening. Yes, just a quick question. In the advent of AI, are you as accountants incorporating that into your business, number one? And if you are, number two, are there any tools you can help us with our profit and loss management? Back over to you.
Am I incorporating AI? Certain aspects of our business has incorporated AI. Me personally, unless there is, AI is incorporated into various accounting softwares. I mentioned Xero earlier. Xero, Sage, QuickBooks, they are all getting sophisticated enough that they start learning. So if you, for example, if you're paying £100 a month to Birmingham Council for rates, council tax, whatever, if you start putting that into an accounting package and keep saying, well, it's £100, it sees Birmingham Council, it will work out that eventually, after the second or third time, that is rates, and it'll put it to rates. So from that perspective, AI is part of our business. And that will save you time in generating your profit and loss account if it is all linked up correctly. So yes, we would use AI in our business, and yes, that would be used to help you guys understand your profit and loss account. As Paul suggested, I've been in this game a little while, and yeah, more years than I care to mention, and I still much prefer the human side of it. So I'd much prefer to have that meeting and discuss it with someone as well.
And can I just pick up on there, literally, we're just 1 minute over.
Yeah.
We are getting to the point that AI will put into your P&L. If you set up a P&L sheet, we are getting to the point that that there will be natural inputs that are put in by AI. And I'll tell you what the problem with that is. The AI machine knows exactly where you are on Wednesday at 2 o'clock with your finances, but you have no bloody idea.
Yeah. And that
Right.
is where MTD is. Once you start processing through MTD, if you're in MTD for whatever in your business and your landlord, once you start putting that in, that is going to pre-populate your tax return at the end of the year. And we always say with whatever program you use, whatever input you put in, be it good, bad, indifferent, or something beginning with S, that's what you'll get out. Good, bad, indifferent, or something beginning with S.
So there's a lot of value, right, in businesses. You do get to a point where if you get to the point that you don't need to you're bringing in so much money or spending so much money that you can't physically put it in, it's probably time you had somebody working inside of your business called doing bookkeeping, right?
Yes.
We've got several of those, right? They're called bookkeepers, right?
Yep.
And all I need to do is look at the P&L, but they know where it is, right? But if you're in a small to medium-sized business, don't rely on AI. Don't rely on AI. This is what I would say. Don't rely on it, because when you put in that number, it's a bit like walking into the analogy I'll give you is it's a bit like walking into the shop with your credit card or walking in with a pocket full of money. If you walk in with a credit card, you forget how much you're spending. If you walk in with a pocket full of money and you count it out, you remember very quickly. If you're putting the information into your P&L, into your spreadsheet, you think, and the amount of times, right, in the beginning of my business, I thought, we have spent a lot of money this week and I'm really struggling to figure out where that money's coming from. And if I didn't follow my own P&L, that could have went on for a month or 2 months. It's amazing how quickly I stopped spending money.
Indeed.
Can I just interject very briefly? Where I was thinking where the rules change, where HMRC rules change, AI will probably be more in sync with that. The things change that we're unaware of. So that's what I was referring to.
I would say with that's very, very, very possible. But then every story has two sides. And AI would most probably take the revenue side. So if there was any grey area over an expense, it would take HMRC side, whether that's right or wrong. So I'd be very, very wary. I will have conversations with clients and they'll say things and then little grey cells start going and you'll start thinking about whether that's what they meant, whether it was something else. You can have a conversation with a person, and I'm not saying you would twist what they say into making it allowable, for example, but tax legislation is not, there are so many grey areas within tax legislation That's why we have the tax courts. And if AI is left to manage this scenario and tax, there'll be no need for a tax court because AI will get it right every time. I don't think so.
There's tax legislation and tax interpretation, which are two
Indeed.
very different things.
I think Imran wanted to say something
Yeah,
as well.
just I think, and then we'll kind of wrap up.
Yeah.
Imran.
Yeah, thank you. So, Brian, sorry to pick on you.
That's all right.
The example you gave about auto categorization of
Yep.
accounts, that's not AI, that's machine learning, right? And that's
Yes.
straightforward. That's been around for decades. There's nothing creative there. However, it would be nice for more accounting software to implement machine learning. AI, however, could be a real differentiator. So going back to perhaps Paul's example of predicting cash flow, predicting a perhaps exposure within your cash flow forecast, that is something where AI can make tremendous inroads within software. And I think that would be invaluable to all sorts of businesses, regardless of size. But I do agree with Paul's comment. As business owners, we need to understand our business. So, for example, as a small business owner, I am the bookkeeper. Certainly when it comes to my rental business. When it comes to my development business, however, because the development is quite a sizable business, we have hired a bookkeeper. Now, that doesn't necessarily mean we don't understand where the numbers are, how the numbers come together, how the P&L is put together, what the balance sheet looks like. More importantly, certainly from a development perspective, what a cash flow forecast looks like, because we've got all sorts of different suppliers that we've got to pay, all sorts of different trades we have to pay. We always get paid by the lender in arrears, right? So we've got our cash flow forecast for us is even more important than our P&L, certainly when it comes to running the business in real time. So just different elements that we've talked about today, extremely interesting. I found it incredibly valuable, and I'm not sure, and I hope the others have done as well.
Okay, and on that, guys, I think we will wrap up. I'm going to kind of tell you my life experience rather than I'm not a great giver of advice or educator. I'm a life experience person and a lifetime in business. It's never too early to bring in help. This idea that we can do things on our own, right, is very rarely true. The thing that I find that most small businesses do on their own is make mistakes. They seem to be very, very good at it. And people like me, myself, and people like Brian and lots of other quote professionals spend a lot of time cleaning up other people's mistakes that had we been brought in earlier, A, the mistake wouldn't have happened, and B, the business wouldn't be where it is. There's a phrase that my dad taught me. It's called penny wise and pound foolish. If you're going to run a business and you want it to be something real, I'm not talking about, you're going to buy one buy to let and you're going to give it to your kids when you die. That's not a business. That's not an investment. That's this hybrid thing that I've never really understood. But if you're going to run a real property business and you want to take it somewhere, the earlier you bring in expertise, the more likely you are to succeed. Yeah. And if you don't understand your P&L, find somebody that does, sit down in front of them and do what I've never been ashamed to do, which is go, treat me like I'm a 3-year-old. I don't understand this. Never pretend to be smarter than you are, because just people who pretend to be smarter than they are make some pretty dumb mistakes.
Yeah, great.
Dan, I'll leave it to you to close down the room. Thank you, everybody, for your time. And next month, you will have Sunil back. I know you'll be very glad about that. Okay. Speak to you soon.
Thank you, everyone.
Thanks, everyone.